Yeah, so we're at the Property Council of Australia's event. So we're at one of their breakfasts, and today's theme is talking about the capital markets in New South Wales and outlook for interest rates and inflation. So I've got a table here, so my team, a couple of clients are going to go in there. Really excited because one of the chief economists from UBS will be giving us a presentation, and I'll be really looking forward to seeing what he's got to say about the budget that was just announced a couple of weeks ago and his outlook on the economy and obviously on the housing and property markets. So can't wait. I think it's starting. Let's go.
At the time, the markets were unanimously consensus for rate cuts. I sort of doubled down on that view now, and I'm saying rates stay higher for longer. And that's a period of interest rates which is going to restrict the economy. The other big pot of money, of course, is superannuation. And housing is the biggest asset on the balance sheet for households. It's over half, but the second one is super, which is 20% share, or about $4.5 trillion. Now, this is the shift that's probably going to happen post the budget, given the tax changes. Net will be a relative positive for superannuation, but obviously there's other tax changes coming through there as well.
Now, what happens in that environment is governments have to stimulate the economy again, and that will lead, most likely, like every other cycle, into some easing of interest rates. And that is a positive for real estate looking forward, because then your spreads open up between your base rates, your bond yields, and your cap rates, your discount rates. So right at the moment, our capital that we speak to is talking with its feet. And I absolutely agree with Claire. It's a relative gain for all the global investors screening APAC, but also screening the world. And APAC investors are generally underweight Australia by a few percent, and that's a lot of money.
Well, from our perspective, it's not all doom and gloom because we work in commercial as opposed to resi, and so with the negative gearing rules around residential, it means you might have people being pushed into the commercial market looking for good investments and property they can earn an actual good yield from, because they can't earn a good yield on resi, so earning good yields in commercial. So we will be chasing the yields in the commercial market more so, I'd say. Things we've been already saying as well with what we're looking for. We're seeing a flight to quality. People want more prime assets, again, good income coming in. But I think we're well positioned with what we do. Large format retail is something we've been targeting recently. Prime warehousing is something we've been targeting recently. And also neighbourhood convenience shopping centres is something that we've been targeting recently. And those are all the kind of assets that are not immune, but will still do well.
From what we've heard from the panel, the safest assets at the moment to consider to invest into is defence, existing houses, blue chip locations, and pretty much that will create a base for your investment to go through this year and upcoming years.
I think there will be opportunities with different asset types, and depending on the time, I think it will reflect on the actual economy and the economic growth that is perceived to have in the following years. So I think opportunities arises, particularly in uncertainty. So good quality assets at a good pricing, it's something that it's worth considering, particularly in the longer term where inflation also equals to the amount of asset price growth. So we look forward to coming year and hope for the best.
I know everyone's going to be chasing yield going forward, so high yielding products going to be the most appealing asset available in the market, so we need to focus on yield.
Well, I think it's not all bad news. Capital still needs to find a home, and I think in Australia, we're very heavily weighted towards real estate. So if the tap is turned off in the residential investment sector, we're going to see a lot coming into the commercial property sector. And I think the other takeaway is there's going to be a flight to quality and a concentration on income-producing assets that are quite defensive. So prime assets in prime locations are always going to win. And I think what we do, we're on the right path because we're specifically looking for prime assets in prime locations that might be undervalued. So if you combine our strategy with what the market is and what some of these panelists are saying, I think you're going to ride out the next couple of years on top. So, it's not all bad news. So I think there's a lot of positive. There's some silver lining in the horizon. But I think what I like to do is to just watch how the market reacts over the next couple of weeks or a few weeks leading up to the end of financial year. But so far, I think I got a lot out of today, and I don't think it's all bad news. I think we're on the right track.